What's going on, and welcome to our PBU Live. I'm here with Pookie's Revenge, as always, and we're here to talk about dividends today. What's going on, Pookie?
Hello.
How are we doing? For those of you who are watching this on YouTube after the fact, just so you know, we do this every Thursday, 2 p.m. Eastern, live in the Discord. We currently are in the Discord with some of our members. We got Breckle, Duco, HS, Latvian, Maestro, and the rest. We got actually a bunch of members. Yojo's here. We got Porterhouse. My Discord keeps doing this thing, so I can't see who the last person is, but
it's me.
I'm not besides you. There's
I'm at the bottom.
Nikki, I can't see.
Oh.
This is S.
Sailor Brown.
Sailor Brown. That's what I thought it was, based off the avatar. So we got and Sailor Brown in the chat. How we all doing? So today we're going to be talking about dividend trading. I know that today is Microsoft's official dividend day, so it's a good day to talk about dividends. And so we're just going to be discussing, first of all, just what is a dividend? How do they work, and how do we find dividends and dividend stocks? What's considered good or I guess low when it comes to dividends, and then how do we invest into stocks, either long term, usually long term, or even on the short term when it comes to dividends and knowing when the payouts happen, all that. So let's just start, Pookie, with what is a dividend?
Dividend is it's an amount of money. Typically, they can also give out different types of dividends, but for the everyday investor or speculator, a dividend is a scheduled payment that a company provides to the investor in exchange for owning that share on or before a certain date. So think of it like an incentive to buy that share. So there's a couple different reasons a company might do that. They might be desperate and they might want to put cash into that allowance so that people buy their shares and the price goes up, or they might just have extra money and they want to reward their shareholders, and they might just offer a dividend to keep them and kind of reward them for helping them out.
Sounds easy enough. So when it comes to dividends, I know a lot of people know, oh, this stock has a dividend, this stock has a dividend. How do you determine what the dividend is, and like when you're going to get paid as an investor, what the requirements, as far as like when to buy and all that kind of good stuff goes?
Yeah, so the only real requirement is that you have to have those shares at the end of day on the date of record. So that is a specific date that a company announces that they will cut off. Basically, the date of record just means that things are stamped in place. So if your name is on that list at the end of the day, you are entitled to that dividend payout. Basically, yeah, that's it. You just got to buy the share, and then you can sell it right after that if you want. But you do collect the dividend. It is paid directly to you through your broker. And the older companies and some other companies, if you're off exchange, they'll send you a check and stuff like that. But that's terrible. But yeah, you also have to claim that on your taxes and stuff. So it counts, but it's still money that you're receiving. So just keep that in mind.
For you personally, I don't know if you have a long-term investment. Are there any current dividends that you're currently invested in, or you're currently watching when it comes to dividend trading, or just dividends in general?
Mostly just the Vanguard stuff. I don't really mess with the blue chips that much on my larger account. I used to way back in the day. I used to. There was a very popular strategy called Dogs of the Dow, which is coming back and it's still legitimate, but for a while there it was just not very reliable. And that basically just means that every new year there are the Dow Jones top 10 dividend stocks, and you just rotate those every year. So you just basically sell and buy once a year. And then you get those dividends for those highest performing stocks. It's a much slower growth strategy. And for a while there, like 2000 to 2010, I think it just wasn't as effective. So I don't really need dividends, I guess. I have plenty of other passive growth strategies in place, so I don't really need to mess with dividends, but it is good.
No, yeah, it's good to know. Definitely. I know a lot of people do just like the whole set it and forget it mindset.
Yeah.
So how would you, if I know you currently aren't in any dividends, if you were to be looking at like top 5 dividend stocks, or just 5 dividend stocks to watch, like how would you go about finding these, finding which ones to look at, just for due diligence sake?
So first I'd go to Finviz and make a list of tickers that I want to look at. And then I would do a deeper dive into those companies. I'd look at the SEC filings, look at the actual dividend announcements, making sure everything is on par with what I'm seeing on Finviz. And then I would add them to a watch list and pay attention to any announcement that company has, because if they have any upcoming shareholder votes or if they have any changes, the amendments to the dividend, that's going to affect my investment. So I want to be aware of that. So basically, yeah, just pick a handful of stocks and just watch them like a hawk. The further catalyst, that is.
So let's go over a few stocks that are, that have pretty high. Let's first go over just dividend yield in general. When you see a stock, has like a, 3.8% or 2.8% dividend yield, what does that mean for you or just for investors?
Yeah, so the dividend yield is just the dividend value per share divided by the stock price. So it's a percentage of each share price, and then you multiply it by 100 to get the percentage. So percent 100. So if, for example, a stock is giving a dividend for whatever reason, a $1 dividend on a $100 share price, that's a 1% dividend yield.
Gotcha. All right, so let's go over some. I see Mr. Stocklock Profits in the chat. I'm just sending you the streamer link in case you want to jump in. And I know you're.
This is his jam.
This is his jam. I know. So, so let's go over some of the, some of the, quote unquote top dividend stocks. I'm just looking up here on Barb. Some of them are. It's mentioning Verizon, VZ ticker. Obviously, we all know what Verizon is. Provides wireless landline internet services. It has a dividend yield of 4.8%. There's Pfizer on the list, Comcast, Wells Fargo, and Gilead Sciences. Is there any there that you personally would like, knowing, these all have these high dividends? Like, how would you go now looking at the charts, looking at the dividend date and deciding whether or not it's, worth getting into for a dividend trade, someone who does, care about dividends and all that?
Yeah, so unless we're talking about like special dividends and stuff like that, where you really want to just trade the dividend itself, you really just want to look at the dividend as icing on the cake for an investment you already have confidence in. So I would look at each of those companies like Pfizer, Verizon, Comcast, and I would make sure that they were stable financially. And that kind of tells me what the motivation is behind them offering that dividend. If a company is offering a high dividend, for example, like 8%, and they are not doing well financially, let's say they're losing revenue year over year, they don't have a lot of cash on hand, that tells me they're probably getting desperate and they want to bribe people to buy those stocks. So the price goes up. But if a company is doing very, very strongly, they've got a lot of money in research, they've got a bunch of catalysts and projects in the works, and they're offering a high incentive or high dividend, I'll probably buy that one as long as the chart makes sense and I can treat it as a reasonable investment. At that point, it's just kind of figuring out which among those that survive that series of filters you can get the most shares of at that point. So it's not so much you just want to buy the cheapest dividend stocks possible or the highest yield. It's you really want to find that sweet spot of good investment first. Then it's an efficient investment, which means the number of shares by the investment yield. And then the length that you're going to hold them. Some companies offer dividends quarterly, some do it annually, some do it semi-annually. So there's a couple different factors that you got to kind of incorporate. And I know this is the PBU, so I'm not like trying to go super crazy down the rabbit hole, but you got to look at the big picture there.
Right. And we actually got Mr. Stocklock Profits now here on the StreamYard artist. If you want to mute us on Discord, Lee, and then unmute yourself, we can go ahead and get your insights on the dividend pick, on dividends in general. There's also some dividend picks you might have.
Teach me.
You there, Mr. Lee, Mr. SLP? Sweet. I see his.
Hello.
There you go.
What's going on? Yeah. What's going on? Yeah. What's going on, guys? No, I'm here to listen to Pookie with all these dividend ideas.
Oh, I'm just making it all up.
Are you?
Yeah.
No, but it's true. Exactly what you say. It's super true what you say. It's like, you can pick a dividend stock and it's a cheap stock price. But if the stock price keeps going down, what's the point in having this holding the dividend stock long term? Because what you're making up for the losses by collecting that dividend, but is the growth of the stock worth being into long term for that dividend payment? You got to look at the fundamentals of the company.
That actually introduces a really good point, though, because there are legitimate times to do that if you're trading the system, right? So. Sorry to derail here, but dividend collection is separate from realized profits and losses. So a dividend payment, it's still receivable income. You still have to file that on your taxes. So you're still responsible for paying on that. So yes, if the stock price goes down and you sell for a loss and it's greater than the dividend yield that you've gotten, you're going to have a net loss overall. However, and this is definitely not for every single trader, but there are circumstances for capital losses where you can claim those on your taxes and actually have a slight advantage because you get a good chunk of that back. But that's a more complex topic. But there is still a little bit of wiggle room there. So if you're a dividend trader and you don't necessarily exceed your capital losses, so you don't have carry forward for the following year and all that good stuff, it might be okay to take one of those towards the end of the year. Just for the dividend, if you can keep that loss within reason. Now, I'm not saying that you just want to buy something just for the sake of collecting the dividend, because as Lee said, if your realized loss exceeds that and you can't claim that, there's no point in doing that. So it's generally just not advisable to do that in the first place. But there are some niche cases where that is actually an interesting point that you can use to an advantage.
I just like to reinvest the dividend that I collect back. I mean, back into the one, the stock that I'm currently in. I mean, if it's something that you're trying to hold long term and it looks good on the chart for continuation over the next years to come, then I just reinvest that dividend. That's all I would do.
Absolutely.
Of course, you're going to pay taxes on it, but I mean, I think it's just better to reinvest that dividend. And just make more on top of that. So,
yeah, drip is a very, very good way to compound your growth over time, and that's kind of the difference. I think just the way you worded that was really good, because you said a long-term investment, and when I was talking about sometimes taking an acceptable loss on the share sell in order to collect a high yield dividend, you don't want to do that for long-term investments or anything that you want to reinvest. That's just a one-off. Like, here's a really good opportunity. I might take the hit on this, but I'm getting the tax advantage and the dividend. But unless you're like fine tuning your trading to that degree, just go for stuff that you're going to like long term, like Lee says, and just don't worry about the difference between a dividend and a capital loss and, and all that good stuff. So ignore me, listen to him.
No, I'm just saying. Also, you've seen like these really good like dividend yields on like these real estate, like office real estate, stocks. But you got to think about it. Real estate, the commercial real estate right now is like, it's like just getting killed basically, right? And I mean, there's so many office spaces empty and they're trying to lease them out. So like the yield may look great, like it's like 8%, 7%, but do you really think that stock's going to perform for you to be able to justify us keeping it for the dividend? Like, it just doesn't. For me, I just stay away from the real estate, like commercial side of things. Yeah. They're very attractive on the dividend yields, but it long term, you're just going to like what's it called, like beating a dead horse or whatever. You're just going to basically get a return on your dividend to make up for all your losses, and it doesn't make sense. So like if you look at the top, I think there's like top 50 dividend kings, like Target. You want to find ones that just increase their dividend year over year, and also their growth, like their fundamentals are just growth year over year, and they have nowhere else to put the money but to the shareholders. I'm all for it. Like the big companies, Target, Walgreens is another one that's beaten down at $22, and they have a 8% dividend yield. They pay about $1.60 a year. I think it is $1.70 a year. And if you catch a really good company, it's maybe it's had a hard time in the past 3-6 months, but it looks very attractive at that like strong support level on like the monthly chart or the weekly chart, and it starts to reverse and the dividend's still there. You're just going to collect the money from the profit from the stock, obviously reversing to the upside, and on top of that, your dividend payment as well, which you can reinvest in the stock if it's close to the bottom of the range. You're just going to keep on making money on top of everything over and over and over. So I like to find like those stocks that have very strong fundamentals. You see the growth in the income, the net income, they have good balance sheet, but they also reward the shareholders. I mean, they're not called dividend kings for no reason.
That's a really good point that you made, though, because I know when it comes to day trading and short swings, everyone's about the charts. But when it comes to dividend trading, this is investing, long-term investments. It really does matter, the fundamentals of the company, which is why it is so important. This week of the university. But you're so right about the housing market. I think. Hey, what's up, Bull? You can join the StreamYard if you want. We are live. We're on YouTube as well. But mortgage rates are above 7% this week. Is a fifth week in a row. So Lee, you're 100%. You might see those big, dividend yields and all that kind of stuff. But if the overall market is not doing well, then
can't support it. Yeah,
can't support it exactly. I have a question though for you, Lee. When it comes to dividends, do you personally prefer to invest in individual stocks or dividend ETFs?
To be honest, I like a mix. If I like a mix of stocks, and the ETFs are going to give you a solid return year over year because they got obviously a diverse portfolio. So when one's down, another one's going to cover that, and so on. So less risky. I think you would want to do more of like an ETF dividend, stock. But for me, I have a mix. I have a few of Vanguards, and then I have a few stocks that I like to keep in like my own little divide, separate from everything, just my dividend stocks, and I just follow those and reinvest and adjust what I need to adjust. But I think if you're starting off, the ETFs are probably the safest bet. They have a mix of a lot of stocks that with inside that portfolio. So if you're trying to dabble your feet, I would say maybe ETFs is probably the best way to start. What do you think, Pooks?
Yeah, so I mean that's perfectly valid. So when I was doing the dividends and ETFs more specifically, I had a 70-30 mix. So 70% of my dividend portfolio was ETFs, and 30% were more aggressive or more efficient ETF companies, actual tickers. And that approach is really more of an investor mindset, and that's kind of where it's important to determine what your goals are and to really, really put in the time to learn about this stuff, which is why I'm glad you're all here. Because if you're an investor, you're going to be looking at the bigger picture. You're going to be looking at, okay, I get paid this much per month. I pay my bills. I have this much discretionary, and I want to put this much into my investments. So, whether you have a 401k, blah, 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 or you're handling it on your own, if you contribute monthly or on a regular basis to those kinds of investments like dividends, and you're reinvesting the dividends themselves, and you're buying more shares, and you're accumulating over time, you're going to have a much more steady trajectory in most cases, unless there's some sort of global crisis, especially if you have a diversified mix of like a 70-30 or some sort of weighted stability in your life, than you would if you just tried to speculate on the tickers and you kind of got, some comes, some goes, blah, blah. Well, you're learning, right? But if you're just looking for somewhere to park your money, that is much more stable and much less stressful than trying to figure out trading and using the entirety of your savings on that. So if you're a newer trader, if you're an experienced trader, if you don't have anything in the longer view, I can't legally tell you what to do, but I would probably consider it heavily myself, just so that there's some sort of passive growth happening no matter what. Because that's kind of why we're here, right? We just want that passive growth. We want things to grow over time and eventually replace our labor income, where we work for someone else and they get rich. So, another major advantage to trading these on the higher scale is not to beat a dead horse, as Lee would say, but to revisit those tax advantages. If you hold a stock or if you hold an ETF for more than a year, your tax rate that you're responsible, your tax burden on those shares is less. And if you're just contributing to your portfolio and you're just buying shares of an ETF or of a company and collecting the dividends and then taking those dividends and buying more shares and buying more shares and buying more shares, you're not selling anything. Unless something becomes horribly inefficient, then you sell it. But at that point, you would have probably held it for more than a year, which means your tax burden on the shares that you sell is much, much less. So your only real tax burden is on those dividends at that point, because you're just contributing to what is effectively a savings account where you control the interest rate. So it's a very good growth strategy. You just have to be patient with it, and you have to determine whether or not that aligns with your goals. So
it's a good passive income. Like people
Yeah.
live like off of dividends. I mean, it's just like an interest. You know, when you earn interest on something, like if you have $1 million on the side, and you're just trying to make some, you know, some passive spending money, you can easily do it with dividends. I mean, they can pay you out just as well.
Well, the golden number is like 100K. Once you get 100, maybe 150K, you could, in theory, live on the dividends pretty effectively, and then you can retire at that point, as long as you don't mess something up horribly. But
well, I'm glad that you all brought that up, because I do have a question for both of you when it comes to dividend growth investing versus dividend income investing. Because I know I just put a chart on the in the Discord chat. I know with the dividend growth investing, you know, it's more long term. Probably leads to something more along your wheelhouse. Is more of a long-term investment strategy where you focus on companies with a history of increasing dividends, ideally companies that, like Pookie was saying earlier, have a better chance of increasing their, you know, the stock price, a solid company, you're looking at the fundamentals. Whereas dividend income investing is more so a short-term investment strategy, just focusing on companies that pay those high dividends and is collecting the dividends and using that, you know, that as your income, you know, even though the stock price doesn't do well. I'm curious, out of those two, what are some pros and cons, and like which ones do you personally, if you were to, I know Pookie, you don't do much dividend investing. If you were to, what would you probably do?
wait,
he doesn't. You don't do any dividend investing, Pookie? He's calling you out, bud.
I don't need to. I got the wheel.
You got the wheel.
No, I have other investments outside the market, so I don't need necessarily to time
not part of his plan.
Yeah, I'm not saying I'm above it, but no. So it would just be a weighted mix, just what I used to have, 70-30. So 70% of it would be the slower growth, less risk, more stable compounding gains where I contribute to it. Say I'm working a job and I would just throw like $100 or maybe $200 a month into it, just to buy extra shares and rack up as many of those dividends as I could and reinvest them through a drip or just manually doing it. And then when that gets rocking and rolling and I'm at a point where I can start to diversify, I'd take about 30% of that worth and put that into the higher risk, maybe a little less when I'm new to it, but when it's full steam ahead, I would say 20 to 30% in the higher risk stuff. And those are the ones that you really just want to pay attention to for catalysts and things like that.
What do you think, Lee?
No, I agree to what Pookie says. But for me, yeah, like I'm just looking, like I just like to look at companies and just dissect them and see exactly where everything's going, and then saying, well, they are a really good, like sound, fantastic company, and I'm all about them, investing in them long term, and then they have a dividend too. I'm all about like just doing my investigation work. So I like a lot of long-term dividend paying out stocks, and I just like to find the ones that just like long-term growth potential, and then on top of that, wow, you're collecting that dividend. So it's like it's great to find. It's amazing. It feels great when you find stocks like that, you know, that are that are giving you a good dividend as well as growing like year over year. You can look at the chart and it's just non-stop. I mean, look at SPY. I mean, if you look at S&P, it's okay, we've had our downtrends, right? But ultimately it's a non-stop train to the moon. That's where it's going. There's been pullbacks, obviously, with recessions, but the actual long-term side, right? And then it also collects a dividend as well. So you can like, those are also a good way to put your lower risk into ETFs like that. And they have good dividends as well. So S&P, NASDAQ, you know, if you do it right, then you can invest in those long term as well.
I'm glad you brought us some examples. I'm going to ask y'all, both you and Pookie, just some different stocks that have a history of paying out really good dividends. But first, before we get into those, I want to see your take on some of those stocks. Before we get into those 5 stocks, I do want to ask you about Microsoft. What's your take on Microsoft just as a whole when it comes to their dividends, the fundamentals? We're less looking at the charts and more so just as a fundamental long-term investment analysis valuation. Yeah. Because I know today is the Microsoft dividend day, and you know everyone's posting on Twitter showing Bill Gates doing that dance he did on
really?
years ago. Yeah,
I'm just not around, I suppose. What's going on with
It was just today's the dividend payout. Today's their national.
Is it a big payout? What's going on?
National, is it big, 272.
Yeah.
It's a 0.8% dividend yield. Yeah.
All right.
So really quick before we dive into the specifics of Microsoft, I just want to point out that we were ambushed, Lee. The fact is, we need to reframe Duck's question and add a column to that chart to accommodate your answer, because that's really what we do. You're not buying those high risk dividend stocks just for the dividend. You're buying them as investments that happen to have a good dividend. So I don't appreciate you attacking us like that, Duck.
I'm just asking you what your take is.
I mean, this is not the first time, bro. Look at him with the
William percent indicator.
Yeah, I'm not about that.
I put you on the spot on that one, Lee. I do remember that. Well, what do y'all think about Microsoft as like a long term, more like a longer term investment? I'm not talking like 3 months. I'm talking, growth stock.
Yeah, I can go first, or Lee. It's up to you. It doesn't matter.
You can go first, Pooks. I mean, I'm looking at the chart, and I'm looking at the chart right now. I'm like, this is madness, but it's okay.
He's just gonna say he agrees at the end.
Yeah, that's it. Move on.
Figured you out there. No, I actually like Microsoft quite a bit. As much as I don't like Microsoft as a name and as a brand, I do like them as a company. And the reason I say that is because they are very good at adapting ahead of the curve, as much as I hate to admit that. And they're just very strong financially, or they were strong financially. So if you look at their their quick ratio, current ratio, it's above 1. So they obviously have enough money. They have a good forward PE. They have a good PE. They got a good heavy institutional ownership. They are heavily diluted, which is kind of appropriate for a company like that. There's 7.5 billion shares, just under that. So just looking at the metrics themselves, it's good. 72.36 billion income, 211, almost 212 billion sales. It's very good. And this is the exact kind of company where you'd expect to see a solid dividend. So if we look at their dividends over time, we can see that they've gradually increased. I mean, all the way back in 2013, it was 28 cents. Then 2014, the end of 2014, they jumped up to 31 cents. So that's a 1/9, which is like a 12% increase. That's a huge increase for a dividend, especially in that era. And then let's see here, 2015, a year later, they jumped up to 36 cents. So they increased it again by almost 20%, or maybe that's a little more than 20%. Then they increased in 2016, again, November. So I'm looking at November here. They increased another 3 cents, which is about a 1%, or I'm sorry, a 10% increase. Then they jumped up to 42 cents, which is another 3 cents in 2017, again, November. And then they jumped up 10% again in November of 2018 to 46 cents. So another 4-cent increase, or 10% increase, just under 10%. Then in 2019, in November, they jumped up to 51 cents. So we're seeing a pattern here that they jump roughly 10% in November, in the middle to the end of November. So as a long-term investment over the last 10 years, that's been incredible. I mean, they're up to 68% as of August 16th, 2023. The payday September 14th, obviously, that's today. But the next item on this list should be the November expected increase in dividends. So there's a couple different takeaways we can take from that. We can take the catalyst itself. We could trade that short term. We can start building into this company's growth long term as an investment, and we can start reinvesting those dividends. And it's just, it's a solid company, in my opinion.
Yeah. And also, I feel like the whole AI is kind of shooting these companies to a whole new level.
Yeah.
And this is just the start of that era, right?
Yeah.
So just think about it, like Microsoft, NVIDIA, all those companies are going to adapt and just incorporate AI even more the years to come. So I think Microsoft is a pretty solid company. Like you say, the fundamentals, everything makes sense. If you look at even on FinViz and you take a look at Microsoft, I mean, ideally where it's sitting the price wise, I don't really like it, but to like add to my dividend, account now, maybe back in January or December, I would have loved it. But now it's a little bit risky. But you look at like the institutional ownership, you look at the return of like the gross margins, the profit margins, all of these are all green, like everything's green. And that's what you want to see, low debt to assets, stuff like that. And it's good. I mean, the PE is not so bad. Forward PE is not even lower, so that's nice. And this company's just, if you look at the chart, it's just been on a non-stop ride up. But it makes sense, right? Because of what they do and what they're investing in, and the whole AI is a whole new level that they're just going to experience, and the shareholders will enjoy that ride too.
Well, think about the technologies we're using. Most of us are on Windows, right? That's already Microsoft. Like that, they're just everywhere.
All about Mac.
Well, if you want to use it right.
I have both. Just have one of each.
That's the way to go. The next stock that I want to bring up to you is Johnson and Johnson. So obviously, we all know it's a healthcare company, long history of dividend payments, and an increase of dividends for the past 59 consecutive years, making it "quote unquote" a dividend aristocrat. Pays a dividend yield of 2.7%, and according to them, they have a strong financial position and stable business. I'm curious what you think about J&J long term. Dividend aristocrat.
You want me to go first?
I don't have too much to say about J&J, but you're right. I mean, they're very good consistently on raising their dividend, and you collecting a really nice paycheck from that. One of the biggest healthcare companies. I just don't like. I don't like what they are and what they do, and kind of schemy, and I don't know. I don't like the company so much, but good for them for having this kind of record of 59 years. You said,
yeah.
Good for them. But I actually don't mind the actual where the stock's at. I think it will grow over time, and I believe that this is like a powerhouse in their sector. So I think this will go to all new highs. And if you take a look at that chart, it's just nonstop. Into the upwards direction. So I think this will just continue to go up. It's taken a huge market share of that sector, as solid fundamentals, income, everything's just like A plus, you know what I'm saying? But I just don't like what the company stands for. I just don't like the kind of scammy, schemish kind of thing that they do. So
is Microsoft.
Microsoft do things that I like, but I don't know, this company causes a lot of problems, so I'm not going to go into it.
That's the socially responsible trader in you speaking.
Just don't go into it. But if you look at the overall picture for this company, it ticks all the boxes to invest in this kind of company long term. It's not going anywhere. It's solid all around.
Well, I think the important part of what you said is you said all those nice things, and then you said in that sector. And that's really important here, because if you look at the things like their current ratio is just above 1. It's not the best. They're not as diluted. They don't have as much income, enough sales, blah, blah, blah. But for that sector, they are superstars. And that's Lee kind of covered all the bases there. I mean, you can look same high institutional ownership, same revenue increase year over year, gross profits, operating income, all that stuff is pointing up, and they've got a lot of potential in front of them. They just need to capitalize on it, as they have been for the last half a century. But I mean, it's if you're looking for things that grow over time and you just make those consistent contributions to those, and you already like the investment itself, then that dividend is just icing on the cake. I mean, these two specifically are very good, in my opinion.
The next one I want to ask y'all about is Procter & Gamble, another company. This one actually
I was about to mention that, bro.
Oh, you were?
Just about to mention that, because I was thinking, well, that one they have so many different parts of the supermarket, even they own so many different companies that you don't even know about, but they're owned by them, Procter & Gamble. So it's you can go ahead and talk about that one.
Well, really quick, they got a dividend yield of 2.4%, 66 consecutive years, even more than Johnson & Johnson. So I'm curious what y'all think about that one long term.
I actually don't like this company. I like that they are diversified, but this is one that I would probably just trade for the dividends, but that dividend isn't quite big enough for me. Just my own personal opinion. I mean, Johnson & Johnson's around the 130 to 150 range. This is a 150 to 160 range, roughly, 140 to 160. It's the same price generally if I'm just making consistent contributions, but Johnson & Johnson has much more potential as a growth investment, in my opinion. Whereas Procter & Gamble, it's okay, but I can just trade this short term as a speculative and then just take those profits and put them into dividends in Johnson & Johnson.
Just buy it on the ex-dividend date and then sell it right after. You know what I'm saying? Because that's we just want to hit it and quit it with this one. But I believe in that because I'm looking at the chart with this one, and you can actually do that on some of these stocks. Like, normally you see a dividend, a stock's price go down when a dividend's released. Normally we see it kind of flat or comes down a little bit. Then they release the dividends, and then maybe we see a nice push right after that. Well, with this one, PG, you can see that the dividend, the dividend's like right here. And I know that you have to have the actual ex-dividend date is obviously a little bit before, but if you see like in April, it gapped up after the dividend. Like, you know what I'm saying? And back in July, it pushed up after the dividend. So maybe with this one, it's good just to get in before the dividend's released, click the dividend and get out, or maybe hold it for a few days for the little run up that it has and then get out and do it again.
Well, I'm glad that you said that because that goes off of what we were just saying earlier about the dividend income investing versus dividend growth investing. We have Johnson & Johnson where you clearly see it more of a long-term dividend growth investment, whereas with Procter & Gamble, it seems like more of that short term, just get collect the dividend and get out type of dividend income investing.
Just think about it. Like the last time you collected a dividend, and it's a huge dividend. It says it's 94 cents was the last dividend on July 20th, right? Yeah. But then if you collected it, obviously before that, like you had to buy in before the actual dividend was released. But if you got in before, and even if you held it through dividend and a few days after, it just kept on rising from there. So I think like this one is actually a great candidate of just grabbing it before the dividend and then collecting it and getting out just after it. I mean, it makes sense. Like look at 2022. It was around $123 a share when the dividend was released. If you grabbed it just before, you had a mega run up to the 150s after that. So I mean, you can probably hold it a couple of weeks after the dividend.
For sure, and it's a quarterly dividend, so you can do this a lot.
You can rinse and repeat this if you want to lower your risk. Just kind of get in before, get out with some good profit.
Yep. And in this case, again, it's just it all boils down to that decision of whether or not it's worth it to hold it or maybe take the hit on that short-term capital, the taxes when you realize a profit. So, if you hold something less than a year, you're taxed at a higher rate. If you hold it longer than a year, you're typically taxed at a lower rate. So if you're looking at investments and you really, really like them for growth and you're not selling them and you just keep adding more shares, there's no tax implication there other than the dividend, unless you're like going through a divorce and then you have like the court getting involved with your assets and stuff. But if you're
we don't want that.
No, if you're just grabbing dividend stocks for the income and you're selling them after the ex-dividend date within a year, it's okay just to take that tax hit most of the time. You're still going to end up net positive. But it really, that's kind of the process of analyzing these and looking at which ones are worth it, which ones are worth holding, which ones are worth contributing to longer term, and which ones you just want to hit and quit.
So like case by case.
Yeah. Yep. And that's essentially what the dogs of the Dow is. You just pick the top 10 highest performing investments for the Dow, and then you just hold those for a year basically. So it's no longer as efficient a system. But the concept is the same. You just have to pick your own ETFs or stocks if you want to do something similar. And then you just reinvest them, those dividends.
Hey, Pookie, do you have a preference between Coke or Pepsi when it comes to just drinking? Not the stock, just drinking.
Dr. Pepper.
I know some people can tell. I personally, if I'm blindfolded, you put Coke and Pepsi, I wouldn't be able to tell you the difference. I know some people like just cannot.
How dare you
despise Pepsi or
how dare you say that?
I know, right? I know. Like people, I've gotten
people
mad at me for saying that. Like,
well, you go to the supermarket, you see which one has the best deal. They're the ones that are hurting the most for real. I mean, to me, that's what Pepsi is like. Pepsi is like buy one get two free, and then Coke is like you have to buy three to get one free. So it's it's totally different.
You want to know something weird?
That's really a good way to do a very, very basic version of fundamental analysis to see what's going on in your local supermarket.
Oh yeah, for sure. And you want to know something interesting is when when I got out of the military, or specifically out of the training phase, right? Because you can't have any stimulants, you don't get any sugars, you don't get any salts other than what they put in the food, and it's all like healthy food and MREs. I grabbed a Coke. I went to the airport for a holiday block leave, and I got a Coke at the airport, and that was the most disgusting drink I've ever had in my life because it was just nothing but syrup and static. But now, if you drink soda on a regular basis, or if you eat sugar on a regular basis, or just comfort food, you're not going to notice it, and it tastes good. But then once you get like separated from that and you go back into it, it's really bad. It's disgusting.
I know. You know what? I'm going to tell you that I'm with Warren Buffett. I drink Coke.
Coke, yeah.
Coke is more tasty, more refreshing to me.
Ben's asking about pop. That's funny. You were mentioning Walgreens earlier, Lee. Walgreens is another one on this list. It has an increase. This increases dividend for the past 47 consecutive years, which is another. This is obviously showing strong, dividend increases. I know they obviously have a pretty strong financial position and stable business. A dividend yield of 2.1%. What do you think about Walgreens? Actually, and then we'll go to Pepsi. There's a whole reason why.
You say Walgreens or Walmart? Which one did you say? I like him how he's asking us questions when we can just say, "Hey, which dividend stocks do you like, Pookie?" Instead, he's asking. He's making us be. We're torturing ourselves by going through all these stocks.
I asked Bard, like, what's the top 5 best
who wants to
dividend
talk
stocks?
about Walmart?
No, Walgreens.
Walgreens. No, I like. Okay, so Walgreens I like, and I like a position. I have a position in Walgreens, so I actually just recently, got that position and started that position. Okay, well, the chart doesn't look so good. The company's going through some transitions right now. CEO's out after like 2 years again or 3 years, so they're transitioning into a new, new CEO. So that's going to come with like whole new like vision, right? So investors are kind of spooked on that. But overall, I like Walgreens. If you quickly look at the fundamentals, they're growing. Their revenue's growing. They have a solid net income that's growing. They have a good cash position. Like everything again ticks all the right boxes. Technical analysis doesn't. There's a lot is downtrending from the 30s, 40s. Now it's down to the low 20s. But there is light at the end of the tunnel, because there's 2 levels that I'm watching. If you're stock trading and you say, well, I like Walgreens, it ticks all the fundamental boxes. I like the dividend that it's paying because they haven't lowered the dividend, so they're not hurting for cash. They have a bunch of cash, they have a bunch of income, so I wouldn't see that happening from this company. Like if their cash flow went negative or something, I could see them like cutting their dividend pay, right? Because that's what you should do. But this company ticks all the boxes fundamentally, but the technical side of things is just hurting. And the only 2 levels I'm watching are the $21 and the $16 range. And now those are the really strong areas to watch. And if one of those levels holds and we start pushing right off those levels, I'm going to go in full position, full pull into that stock and collect.
This is recorded, so don't do it.
Sorry, my bad. Not a full pull, just a partial. And I'm just going to go right into Walgreens, a pretty good size, and I collect that dividend over time, because we're down to like 2012 levels, stock price levels. But you look at the fundamentals, it's grown so much over the last 12 years that it doesn't make sense that it's all the way down at this level. So as long as these levels hold, I love the company. It's like a 48-cent dividend every quarter. I didn't even look that up. I just look at it too much in the past. I'm like, it's 46, 48, something like that. And that's like $1.70, $1.80 a year you collect.
Well, the nice thing is it's constantly increasing too with that dividend payout.
It's increasing. It's like 9% or something, 8-9%. And if you find the bottom of the stock and you just ride that up over the next maybe 10 years, who knows? I mean, if it's the bottom and it just runs up for 10 years, just like it did from 2012 to 2022, then you can collect a huge dividend. You get your tax. Obviously, you get tax break, Pookie. Like we were saying, you're holding the stock more than 12 months. You're reinvesting the dividend. You're going to make a ton of money.
Your investments are literally paying you without even the investment making any money. But
if it's the bottom, say if it's the bottom and they don't cut anything and it's the bottom, it starts reversing for the next 5-10 years, right? It's the new CEO comes in, everything booms again, the pharmacy booms again.
It's Austin.
What's that?
It's going to be Austin.
Yeah, exactly. And everything booms for the company. This is something that you can hold long term and make passive income on. And I do like Walgreens right now more than a lot of other stocks, and Target I like as well. That's a dividend stock.
So I know we were talking about Pepsi and Coke, and we're going to bring up Pepsi in a second. But I do want, those are big competitors. I want to talk about
CVS.
What Stickman, I brought up CVS. They also have a dividend yield of 3.43%, and has been increasing for the past 47 years consecutively. So they're obviously no slouch when it comes to the dividend game. What do you guys think about CVS when it comes to its long term?
Oh, Pookie knows about CVS.
Yeah, so I think a lot of these particular pharmaceutical outlets are potentially going to get a lot of scrutiny, just not from a fundamental evaluation standpoint, but there's going to be a lot more public pressure to crack down on pharmacies and things like that because of the opioids and things like that, and just seeing the reaction from the most recent crackdown about the pharmacy techs not requiring scripts and things like that, and not following protocol and ignoring like the red flags and stuff like that.
That's terrible.
I think that will eventually be sufficient enough to prompt Congress into taking action. Now, it's not going to happen yet because they have their own little fish to fry with crypto and AI and stuff. But I do feel like that when things slow down enough and there's less, recession issues and things like that, there will be some sort of stricter regulations put in place on pharmacies. And that's going to kind of separate the ones that are willing to and able to survive and comply versus those who aren't. So I like CVS, but I mean, if they could just cut back on their spending with those receipts, I think they'd be in a better spot. But no,
you want to send like digital receipts instead of paper ones? Is that what you want?
Yeah. No, I mean, they're very efficient as a business. I just worry about the overall sector getting some crackdown at some point.
And you said that wasn't technically fundamental now, but I think that's definitely fundamental now. It's like we were just talking yesterday about event-driven analysis, economic indicators as well.
Oh, yeah.
I just dropped the links to those. But I think that's another really, really, really important factor to keep in mind. When it comes to breaking down these companies, is also just what the state of the nation, the state of just different news-based analysis like that. Lee, what do you think about CVS?
CVS. Well, same thing as. Hold on 1 second. Okay, I'll be right there. With CVS, I think there's a lot of opportunity there, but you are right about the opioid lawsuits and the big implications that these Walgreens has to pay, CVS has to pay. You've seen, right? Is it Rite or whatever? Rite, yeah, that one also just got didn't they just go through bankruptcy or about to? They're saying that maybe they'll do a filing for bankruptcy. So there's implications, but if the ones that are going to come out of it would be a company like Walgreens and CVS. I think those ones, they have so much assets, and also like you talk about the prescriptions and stuff like that, all trickles down to the doctors and hospitals and stuff like this. Like they all need to get their act together here, and get it all into perspective and do things right. So they do need to pay for things. If they did it the wrong way, then they need to pay for it. They need to pay for the damages. But CVS, like where we're priced at right now, I like Walgreens over CVS, but it is a very good competitor. But I just prefer where Walgreens is over CVS.
I'll have to play devil's advocate here. I don't like Walgreens. I like CVS.
Well, you got to think about it too. They also are very smart. Both of them are very smart. CVS have gone more healthy way because they're like, hey, I'm throwing cigarettes out the door. You're not buying cigarettes in the pharmacy anymore. They've gone more cleaner. Like that's how it should be when you're going in a pharmacy, not buying things that are unhealthy.
I'm actually really curious, really quick, because Stickman, and while Lee says this, everyone in the chat, let me know, because I know they have them probably in both towns. Let me know if you go to Walgreens or CVS, so that's another good way to see what people go to.
Well, look
sorry,
across
Lee, what
the
were you saying?
street. Look across the street. You see a Walgreens, and probably across the street you see a CVS. They're like every gas station on the corner fighting each other. That's how Walgreens and CVS are.
So I did also write in the chat. I said Walgreens bought Rite Aid, and that was unhealthy. So.
Oh God. But also you got to think about it. The CVS and Walgreens are both in very good positions, because now they're trying to get into the healthcare industry of like, hey, we got our own doctor offices inside of the Walgreens or the CVS. Come see our physicians, and they're owning. I forgot who Walgreens owns. Like there's one of these health companies that actually has clinics. And I think that is a very smart move. So they're, broadening their spectrum of not just doing pharmacy and prescriptions, things like that. They're also going into their healthcare and trying to tap into that industry as well. And I think of CVS and Walgreens, they're both trying to do that. So we'll see which one comes out on top.
Yeah, it's a Village MD. That's the one.
Village MD. That's Walgreens.
Yep.
That's right. And CVS has two, I believe, too. I think it's like, is it Signify? Is it Signify or something Health? One of these companies that they own as well.
Yep.
And they're doing it. They're adding them in. They're buying them, acquiring them, and they're trying to take that sector. And we see which CVS or Walgreens wins that battle.
Well,
I'm Team Walgreens at the moment.
For now, yeah. We'll see.
He's smiling better in the picture. The CEO was smiling a little bit better.
No, Sue. So that's interesting, though, because we have two different approaches. So Walgreens, for example, is one that I would just pump the dividend and get out. Whereas CVS, I would hold it long term and invest in it. So that's interesting. But one of the really cool parts is it doesn't really matter, right? Because it's the same end result. We're just getting compound growth and dividend reinvestment. So it's pretty cool.
But if you're long-term trading, and you gotta invest in stocks that you like, I think that companies that you like is stocks that you should invest in long-term, like companies you believe in.
Yeah, well, the interesting part about Walgreens and CVS both is they're adopting the same models that insurance companies and hospital networks do, because they're so closely affiliated.
Yeah.
And they're going to be much more aggressive over the next 10, 15, 20, 30 years about taking over regions and sectors and things like that and trying to just consume as much as they can. Because that's what hospital networks do. They just try to get all the offices, all the clinics in an area. And then they get in bed with insurance companies and things like that to edge people out. And that's exactly what you were seeing with like Rite Aid, Walgreens, CVS. So we're going to see a lot more of it.
Walgreens is in some sketchy neighborhoods. That's hilarious. Fantastic. And Eckerd's, I remember that too, Nikki. They have one here in Florida, like everywhere. There was Eckerd's. Now they're shut down.
They didn't make it.
I'm curious what y'all think about Pepsi, PEP.
It's all right. I mean, I like Dr. Pepper, but whatever.
They got 2.8% dividend yield. Dividends been consistently increasing the past 49 years.
Yeah, so Pepsi is like one of those ones that is just like a staple. Pepsi and Coke and I forgot the other one. But yeah, so just my brain
Dr. Pepper.
Like, which one are you thinking of? Like Pepsi, Coke, and root beer? Like
Fanta.
Fanta. Oh, Fanta. Okay. Like
no.
Fanta.
Yeah. So Pepsi's like oh god, Pepsi's like a staple of growth portfolios, and you can see that's if you look historically over like the ETF weights and things like that, Pepsi and Coke tend to be in most ETFs at some point, unless they're like sector specific. Just because they're very stable with the dividends, and they can also leverage those shares and all kinds of good stuff. But it's a very, very high participating company. And they're even less diluted than the other companies we talked about. They're only 1.3, like just under 1.4 billion. And it's almost 50% higher price-wise for the shares than the ones that were in the 130s. And it's at like 181 or something like that right now. But they tend to stay, 170 up to 200 or below there. So for where we're at right now, this is a much more efficient dividend stock, in my opinion. just by them not having as much dilution. However, the dividend is lower. So there's a little bit of an interesting thing happening here with Pepsi. This is one that I would probably trade long term and just contribute to over time. But it's just not my game anymore.
Who do you know who owns Gatorade?
I want to say that's
Don't I hear you guys typing away. Let's
I'm gonna
hear
now.
what these guys say in the lounge. Who owns Gatorade? Who owns Powerade?
Pepsi owns Gatorade.
Okay, Google, fantastic job.
I did. Well, I thought it was Nestle for a minute.
Yeah, no, so Gatorade owns.
Powerade is Coca-Cola.
Is owned by Pepsi. Yeah, and Powerade is Coca-Cola. Isn't that crazy? They're always competing. With each other. But Pepsi overall, I don't know. I don't really look at Pepsi stock, so I don't really. Yeah, it's whatever.
Which one
it's
can
on its
clean
way
it
up? It looks like it's on its way up again. Broke through this trend line. So I think this would go back up to the 190s again shortly. What do they pay? What kind of dividend do they pay?
Which one, Pepsi?
Yeah, Pepsi.
2.79%.
Yeah, I know.
It's a little low.
Movement.
It's like $5.
So I've got to wait. Like this is one that you get in just before dividend and you get out again because it's just like flat. You don't make much. But you can also we're talking about dividends, but you can be like Snowflake and be cool like him, and just play the calls and the puts all the time while you're holding maybe a position. You can just make money on that side.
Well, if you look at the 1 week chart for Pepsi, you can see a strong support line, and it's been in this channel since early last year.
Yes,
obviously I don't have my screen up right now, but if you look at the monthly chart, that is an investment.
Yes,
that's nice.
Yes, it is from inception.
Yeah, that's good stuff. Let's ask Duck some questions.
Yeah,
I'm trying to do the math here on this AT&T thing. Let's see what would happen if you bought the stock. You bought $100 of AT&T right before.
Just imagine with AT&T, like the worst thing is like this is the bad thing about trading. Sometimes it's like, okay, well, I'm a long-term investor. I bought Walgreens in 2012. I'm holding it, and I'm like, oh yeah, I'm making like I'm up 100% plus whatever, and then within a year, you go all the way back down to where you were 12 years ago. It's within a year, within 6 months.
Yeah, so that's why you just can't look at it.
You got you got to also look at it too, because you don't want to just lose all your profits, right? You're like, oh, long term, let me not check it. No, you have to check it as well. But just a lot of these like dividend stocks can easily do that. So you want to be careful on that.
Speaking of that, just really quick, because I just did the math. So AT&T, they had their last dividend date was July 7th. That was the ex-dividend date. So that means if you bought AT&T stock on or after July 7th, you're not eligible. And they had their payout on August 1st. So in theory, the stock price, if you bought like right before the that ex-dividend date, you would have been buying at around like $15.59. And then had you sold right after you got paid your dividend, you would have been looking at around a loss of looks like $1.20, or no, it looks like it went down to close of $14.30, like around $1.29. So in theory, you would have probably lost around, if you put $100, $8.20 on the investment in the stock, but you would have gotten a $7.68 payout in dividends each year.
Also,
it goes stock by stock. That's what I'm saying. Not all of them work out great, and also they had real bad news. And this is AT&T that shouldn't even have a dividend, and they should just reinvest that in their company, right? Because their cash flow sucks. Everything sucks for AT&T, and they need some cash. And I think that I know it may hurt the shareholders, but sometimes you have to swallow your pride and say, look, I need to reinvest this cash and cut my dividend because
we need the money.
Yeah, we need the money if we want to stay afloat, because there's one thing being, oh yeah, we have a dividend, and there's one thing, hey, we're out of business. So I'd rather cut one and stay in business.
A lot of crypto and NFT projects did the complete opposite, or did kind of what you're saying actually. And they did a lot. A lot of their the marketing and a lot of the money that they took in from their investors. They were spending it on marketing, giveaways, and just giving money away, basically just giving stuff, giving, making all the holders happy. But then it came down to it, like they had no money to actually invest in the business, and a lot of them failed because of that. So like, it's a really good point, when it comes to dividends, like these are legitimate companies with like teams and big, they know what they're doing when it comes to dividend payments. I know you said AT&T, like they've been increasing their dividends for the past 37 years, which is wild. They got a 5.2% dividend yield, which is it's pretty wild for that company.
They cut it. You sure you got the right numbers there?
I mean, this is a quarter. I'm not. I'm looking at the stats here.
Pookie,
if you think you're smarter than Bard,
right? Let me see if they really did cut.
This is as of a certain date. I think it was like probably as of 3.
Maybe not. Maybe they. Oh no, they did cut it, because in 2022 it went from 52 cents, and the next quarter went to 27.
So that must have been the first one in 37 years.
So it must have, I don't know. This is a company that needs to just be off that list and say, I need the cash. Let's reinvest this. Let's reinvest the money long term, and let's start boosting this stock price back up again, because this is down in the dumps. Looks pretty attractive now, like selling up, Pookie. It doesn't look so bad right now. But it's hurting. I think it's hurting for like cash. I mean, they spent a bunch of money when they were running the new, I think like fiber optic or whatever. They used their own money to run this whole new like cables or whatever. So they need the cash, and I know it may hurt the company like the stock price short term. Long term though, I think that they can spend that money on better stuff. More free flow cash, and just spend it on their business model and growing it again from within. And then there's a company, then you can be a company where like Microsoft, where they just have too much money, and they're like, you know what, we've got to pay off our people because we just have too much. Like there's nothing we can spend it on, that we'll just spend it all. We need to just give it back to the people.
Right. So I can make it really, really simple. If you guys are interested in trading dividends, right? Because you know what the dollar amount's going to be. All you have to do is take your entry and set the dividend price as your stop loss. So entry minus dividend is stop loss.
Yeah, that's true.
And that's it.
Do that. That's it. Wow, we've been here for an hour. We didn't even think about that.
Well, so
let's just do that.
Back to Duck's example where he, there was an $8 loss and things like that.
Yep.
$7 dividend payout and stuff like that. It's important to keep track of that because of that max capital loss claimable per year. There is indefinite carry forward. So if you're down like $6,000 this year and realize losses, as long as you don't repeatedly re-enter those positions and you can claim that amount, not barring the wash sale rule is why you don't want to just keep re-entering the same stock. That $8, as long as you keep that limit, that level down quite a bit, you pretty much get that back at tax time. So in those scenarios, as long as you're keeping your stop loss within that range of the dividend price, just keep track of that. And if you don't go over like $3,000 a year, you should be fine, and you should be net profitable as long as you, again, just follow those very simple rules, and you don't have any like crazy tax circumstances. Again, I can't give you tax advice, but we can take these different pieces that we're learning and we can start to put them together to make sense of the pieces and the overall picture. So if you know that you can claim up to 3,000, just general speaking here, there's obviously exceptions and stuff. If you know that you can claim up to $3,000 losses, and you know that if you re-enter those trades or those positions within 30 days of selling for a loss, you can't claim that. You know which losses you need to keep track of that you can claim on your taxes. Same for profits. You know which ones you can, which ones will show up on your Schedule D at tax time. So you also have a system now where your max loss per trade, in theory, should be less than the dividend payout, which means that for every dividend payout, as long as you're using appropriate positions and percentages and things like that, and you're keeping it within that realm, you should be net positive if you're profitable more than you're not, right? So automatically, just taking those four elements together, you should be net positive after a year, is what I'm trying to get at. So even if you don't understand anything about charts, if you don't understand anything like how to read trends and candles and things like that, as long as you know how to place buy and sell orders, and you know how to identify prices and can do simple math and understand not to just keep jumping into the same stock. If you're $6,000 down and it's January 5th and all you've traded is SPY, that means you're just jumping in and out, and you can't claim that on your taxes. So dividend trading is not necessarily going to save you in that case. But knowing about things like the wash sale rule and how dividends do compound, and being able to slow yourself down and diversify, so you're not just trading SPY and just trading 0 days and just trading like super risky things, it'll be a lot easier to crawl out of that hole. And just knowing what cards you have in your hand and can use, like the indefinite carry forward, and the difference in tax rates when you hold something short term versus long term and stuff like that. I mean, just understanding all the rules in play is far more important than any individual trade or individual setup. So that's why we try to give you guys the education first, because again, you could just take those 4 elements and form a plan that will make you net profitable if you follow them.
No, I mean that's why, like you said before, it's so important to to learn not just the day trading, the options, or crypto, the fun stuff. There's also, but it's also good to have some other diversify your types of investments. Ideally, your passive incomes, paying your bills, and your active incomes funding your investments. And
it should be it should be number one, like one of the number one that you should put a good chunk of your money in. It's option
Stability.
trading is like 1% of your account, or like it's tiny amounts like that. It's just like play money, to be honest. When I'm trading options, the real money goes into long term and companies that are just more solid and that have dividends and stuff like that. So
we'll break down the math, right? If you're working a job and let's say you want to contribute $250 every month into this portfolio and you want to grow it and grow it and grow it, for the first month or so, you might not be able to buy anything, right? But if you double that amount the next month, you've got $500. Then you could start getting the smaller equities and things like that using the 10%. Anyway, fast forward like a year, maybe 2 years, maybe 3 years, you can start getting into the bigger investments. You can start to commit more to ETFs. So if you take 70% of your account and you break that 70% up into 70% and 30%, and you put 70% of that 70% into slower growth, less risk, stable ETF dividend investments, and you put 30% into higher risk individual company ETF investments, dividend investments, that 70% of your portfolio will grow on its own as long as you follow those 4 criteria and you have some basic rules in place that make sense. You should be net profitable on the majority of your account right there. And then you can take the rest of the 30% and you can break that up into trades, the active trades. That's short-term speculation rather than investment. So if you do that and you just keep contributing to your portfolio and you continue to learn and you contribute to and you keep yourself within those boundaries and you're not overlapping and committing like 70% of your portfolio to SPY, you should be net profitable over time. And you're not only just a short-term speculative trader, but you're also an investor and you're growing your account and it's growing itself. And that's how you allow yourself to take that passive income and allow it to substitute your hard-earned money, your hourly wages that you're working hard for to make someone else a bunch of money. They're giving that money to a bank and they're doing the same exact thing we're doing. So don't short.
Yeah, it's just play money, like with the options. Like we do it in the group, and it's fun to trade them, and I make some good money. But it's not like
That's not paying my bills.
Yeah, like it's just play money for me. It's like you can have good green day, and then you can have bad red days with options with other dividend and long term stuff. It's like it's just like a growth. Like the goals that you have, and it just grows gradually, but it's consistent. And I'm all about consistent because I'm obviously older, and you want to retire and you want to get to a goal quicker. And to me, growth and consistency is like number one for me.
That's why we focus so much on education here. I mean, even to the point where we're shoving it down.
That's why I do rest and retire.
Yeah,
that's why I do the articles for rest and retire all the time.
Well, it's really important though, because there's a lot of other groups that they're showing you all these options day trading. That you assume like, oh, that's what that's all that person's doing. They just trade options all day. 100% of their portfolio. It's not really how the goal is to So ideally, you're going to get a big options account eventually. That's because you already now have a big investment account or a longer term swing trading account because you learn how to trade and invest and become a real trader in the case, because now real traders aren't people who just gamble and hope for the best. So it is really important to get the education and realize that these people who are showing these big gains, you should look at their investment account because that's where it all started, and that's typically where a lot of those funds are coming from.
Well, if you
plus with option trading, your confidence level gets through the roof, and it can burn you very quickly. Yeah. I mean, I've been up days 20K, the next day down 10K. Yep. I mean, honestly, I feel like I'm on cloud 9, and I'm just like, oh, I'm gonna go for it again today, and then you get smacked. And then you realize, and you come back down to earth, that you shouldn't be playing this kind of money in the option world. If you have one good hit and you're making 20K, then maybe you should just take out 19K of that and spend just 1K on option trading and be smart about it, because you can easily flip. It can easily flip 24 hours from there. You can be on cloud 9 and down in the dumps the next day. So you if you got some big wins on options, you want to reinvest that. Well, I'm not telling you to. Like I said, it's just something that I would do. I would reinvest it into something different, not options. Just reinvest that into long-term stuff.
Yeah, and then it can turn into and then that long-term investment can eventually turn into that 19K you can throw into options.
Right. Well, if you think about it, right, if you keep a smaller if you keep a smaller amount that you're exposing to those higher risk opportunities like options, and you make profits on them, you take those profits out and you put them into the passive growth. And that's what really fuels that machine. That's what compounds your growth over time. And it doesn't really take that long. I mean, we might think about it as it might take a couple decades. It really doesn't. As long as you're consistent and you're not giving that money back. So if you're someone who's struggling and you're just red all the time, even if you just stop trading and just started getting into things that are more passive, slower growth, and you take yourself out of the equation as much, you'll be better off, because you're not just not making anything, but you're not losing anything, or at least not as aggressively, right? So if you look at your overall P&L for the year and you're down $9,000 and you've got $150 left in the market to trade with, that's not working. And the reason for that is because you don't know how to slow down. And it's never an easy conversation to have, but I don't want to see anyone go negative or try to find themselves in a position where they can't dig out of a hole. There's always a way to dig out, but it's best to just avoid that altogether by putting the bulk of your money, your savings, into something more stable and more passive, and then treating it like a savings account rather than a casino. Because if you want to get that Lambo today, you're going to have to put a big down payment on that.
You don't want to be able to put yourself in a situation where you can wipe out your entire trading account, all of your trading in one go. That's just that's basically the gist of it. And that's easy. It's easy for that to happen if all your money is in options. You can have 2-3 good years. You can wipe that all out in one bad year. That doesn't typically happen with investment trading or investments in general, just long-term investing when it comes to the market, unless obviously COVID or the 2008 crash happens.
Yeah,
that's what happens. That's also, just real quick, that's what happens for actual human traders. Emotions get involved in a lot of decision making, and and I've had I'm no kidding, when I first started trading, I've been in and out of so many stocks. I'm making some money, right? I'm moving around and I'm trading 10 different stocks in a month, but then I go back to the stock that I bought in the first of the month, and it's up 50% if I just held it through the month. So I would have done less and would have got more out of it. So sometimes you just got to kind of just chill a little bit, and just if you got yourself a good position, there's no need to rush into other ones and get out of that one. If it's a good, AMD, guys, I'm not kidding you. I had AMD at $8. I had AMD at $8 in 2015 or 14, something like that. It was $8. I sold it and I kept on selling it back and forth up to $30, got out of it. And just imagine if I just held that from $8 and I had a big chunk of it to 15K. I would have just made a ton more money doing less. Right?
Stickman took really quick. Stickman took the word I was about to say. Because I see Stickman and Duca talk about the hole. I'm like, when you get yourself into a hole, you're not going to use a shovel to get back out of it. You're going to use a ladder, and that's the whole thing. If you get yourself into a hole, options trading. Ideally, stop using options trading to get yourself out of that hole. If you find a different way to get out of that hole, you're not going to, like I said, you're not going to use a shovel and use a ladder, like Stickman said.
Well, sacrifice. No, you're fine. So sacrifices have a habit of compounding, right? Especially in the stock market. So if we think about it as a journey, right? New trader comes in, they have all the hope and ambition in the world, and they've watched all the YouTube videos. They're confident, right? They're full of confidence. They maybe find a little success on the equity side, maybe find a little success on the option side, and then there's always that one defining moment where 90% of the portfolio is in something super risky. It's down, and they start to compromise, and they don't want to see it go down to zero, but it ultimately does because they couldn't take that hit. And then what's the first thing they do? They put more money in their account and they re-enter that same position, trying to get it back, or they try to trade the same stock. Usually it's on SPY. Usually they just full port YOLO a SPY trade, and then the next payday they're like, oh, I got to do it again. I got to get all that money back and then some. And they see someone else making a bunch of profits, and as soon as you re-enter that big loss, as soon as you buy that stock or buy that contract back, or it doesn't have to be that same contract, obviously, but that same ticker, like let's say you lose $2,500 on SPY and you're on a $3,000 account and you buy SPY, even if it's one share or one small contract, you lose the ability to use that loss as a tax advantage because of the wash sale rule, as long as it's within 30 days. So not only have you lost that cash, but you can't use it on your taxes. Your emotions are probably all jacked up. You're not getting that money back. And you're probably just going to lose on the next trade because you're probably just using the same system, the same habits that landed you in that first loss altogether. So it's just the cycle of compromise and revenge trading. And we got to get you guys, not you guys specifically, but our goal is to get new traders out of those habits and to, as Doc said, just prevent them from using that same shovel to try to dig themselves out of a hole, because all you're going to end up with is more hole. I'm sorry.
So yeah, I love. I don't know where we went on that one, but I do love dividend stocks.
Well, so yeah, I was getting back to that. Sorry, you didn't let me finish. And again, you can avoid that hole altogether. You can just walk right around that hole if you guys diversify properly and have that solid foundation for slower passive compounding growth. Trade SPY all you want. I don't care. Just make sure it's on a reasonable position that you're okay putting at risk if you're going to, and don't use your life savings just to trade risky things like SPY or Tesla puts 0 days and things like that, because that's what messes people up more than anything else. There's absolutely nothing wrong with just treating your portfolio like a savings account and just making consistent contributions, letting those dividends rack up on solid investments, and just using the tax advantages and every other element. The goal as a trader, and this is kind of how you know you've made it, is when your obstacle is trying to min-max your taxes rather than trying to win trades. So when you get to that point, you've made it.
Think of those risky types of plays, and risky plays. It's really dependent on the trader. Shorting could be risky for one trader, not for another. Options can be risky for one, not for another. It really does depend on the trader. But for a lot of traders, options trading is very risky because a lot of us are relatively new. New is 4 years. Like if you haven't been doing it for more than 4 to 5 years, you're still new to it. Like I'm still new to it. Like a lot of us are still new to it. So like think of these risky plays as like your dessert. You're not going to have your dessert. You're not going to let your kid have their dessert if they didn't eat their dinner first. Their lunch and their breakfast. So you want your passive income. You want to make sure you're taking care of that. Getting that in check, and then if you have some money left over, throw into the risky play. That's your dessert. But, you're not going to have your dessert unless you already had your lunch and dinner and breakfast too.
Well, here's a good exercise, right? I think this will probably be a good little happy ground, right? So if you're working and your goal is to add $100 a month to your portfolio, and you're dead set on treating your portfolio as a savings account, after you hit a certain level, maybe $500, right? Every new $100 that comes in, pretend that you put it through that filter of options trades or something risky, right? If you would lose 20% on that $100, you would still have $580 in your portfolio because you're still putting something in. But if you don't risk that $500 that's already in there, and you're committed to not risking the old money, but instead you're committing that old money to passive growth and it's just growing on its own, you're going to have a much better time, and you're going to have a more stable trajectory to the upside, especially when you do things like the wheel and dividends and other other opportunities outside the market. So if you insist on trading those riskier trades and you want to take those extra profits and put them into that passive growth, that's awesome. But I would caution you from touching money that you've already kind of tried it with. And the money that survives, you kind of shouldn't re-expose to that same risk, if that makes sense. And if you do take a big loss, say you put 90% of your portfolio in something, realize that you can still use that loss as an advantage at the end of the year on your taxes in most cases. Again, I have to do that disclaimer thing. So it's not over just because you lost on one specific trade or a big position. You just got to stop jumping right back into that same thing. So if you can figure that out, trading gets really boring real quick. That's what we want, though.
Yeah, that's the goal. 85% strategy. You don't want to be going crazy here trading, stretching yourself out the whole time.
No, keep it small. If you just took all, literally, if you just treat your portfolio like a savings account and just contribute to it monthly, there's nothing wrong with that. You don't have to trade a cent. But if you do, you want it to be worthwhile.
Investing, yeah.
I mean, no, that's the you do the investing, that's how you in theory trade, and then if you have the time or the skill set, education, then then you can get into the day trading options in a way, and as a way to put extra funds into that passive investment, or whether it's passive or not, just the investment strategy that works for you and is less risky for you.
Yeah, well, so let's just go through the math, right? If a stock, I know the pressure here is that everyone wants to make enough to pay for premium, they want to make enough to pay for options, and they want to grow, right? They don't just want to be here and survive, they want to grow. So if you take a $5 dividend, okay, and it's got a certain price attached to the shares, just break that up. How many, what is your goal that you want to make from dividends, for example? And how many shares can you buy, or how many shares would you need to buy to accomplish that, just to offset the expense, right? And then how much money would need to be in your portfolio that you shouldn't dip below in order to get to that point? And if your number is greater than the number you currently have, and you're trading things that you're consistently giving profits back on, like SPY 0 days and things like that, that's a good opportunity to take some of that money out of the mix and start putting it towards that bigger number to get that dividend process rolling. And that alone, that'll change your mindset. If you just say, okay, I need to make this much in dividends or this much consistently to offset, XYZ, I need to start saving for it. And you start saving for it, that'll automatically force you to want to use smaller positions on riskier trades. And that alone, regardless of what your reason is, if you just do that, you're going to lose less, which means you'll make more. I'm done rambling, I promise.
I am going to end the YouTube recording just so it's getting kind of long. I know people probably don't want to listen to too much when it comes to the people. Obviously, live was one thing, but when it comes to the recordings, I'm going to try to keep them somewhat short. So I'm going to go ahead and end the recording. I'll still be in the Discord for a little bit. Those of you who are watching after the fact, we do this live 2 p.m. Is it 2 p.m., right?
Yeah, 2 p.m.
Like an hour and a half. Well, yeah, 2 p.m. Eastern every Thursday. I was like, is it 2? Because it's already 3:30. Yeah, 2
He's only
p.m.
ending
Eastern
the YouTube so he can swear.
So tune in next time live, and we're gonna continue rambling, as Latvian said.
Yeah, I'll turn your volume up in Discord, and we'll